Awesome, guys. I am Sebastian Salinas. I'm the program director here at TIE Atlanta. We're really excited for today. We're actually going to be doing our module 3 and 4 of the ATDC and TIE Atlanta 102 financial literacy course. And we're really excited to bring up our speaker today, Gregg, who runs Integgra, and he'll be running today's module 3 and 4. So Gregg, if you want to do a little intro for yourself.
Sure. My name is Gregg. Ficery is how we roll with the pronunciation, but I respond to Ficery, Ficery, and Fiercey most of the time. I've started Integgra Valuation and Advisory Services in 2011 after having worked at Silicon Valley Bank in their valuation group, which was called Analytics. It used to be a good thing to say I want to work for Silicon Valley Bank. Not so much anymore. I've also worked for illustrious companies such as Freddie Mac and WorldCom. Quite the resume. I think I'm the only person who's worked for all three of those companies in the world. Thus, my company is called Integgra. Little lesson learned there. So been in valuation for about 20 years, done about 1,000 valuations as best I can estimate, and with a specialty in the early stage company valuations, particularly for funding and stock option pricing, also known as IRS 409A. And so that's what we'll be focusing a lot on today. Got to know your audience. We're going for 2 hours. We kind of got a double header going. So we're going to tell some stories as well, to try to keep you entertained. We're not going to get into the weeds too much, but and we'll try to make it as interactive as possible, at least as we can figure out how to do that with Zoom. So hope you have lots of questions as well. I don't want to hear myself talk for 2 hours, and let's try to have a little fun. All right. Sebastian, anything else?
Nope, that's it. Keep going, Greg.
Okay. So how many attendees do we have, Sebastian? Let's see. You can see the list here. See if I know any folks. I see Raul. Hope to see you tomorrow at TICon. Again, Raul or TI Connect. Anybody else? Do we have the ability for people to say hello and say what they do, where they work? I see Adam. Let's Adam Hayes is first. Can we ask Adam to unmute and give us an intro?
Yeah. Hey everybody, my name's Adam Hayes. I work through Georgia Tech with the Manufacturing Extension Partnership. We help manufacturers with a variety of services, and my main role is to help them with their strategic planning, and that often evolves into a conversation about value or succession planning or advisory boards or things like that. So that's the reason I'm listening today.
Okay. Then we have Deb Hawk. Is that how we say it?
Yeah, it's Deb Hawk. Sorry, I'm just chilling on the couch watching this. So I am the founder and CFO of a data and analytics company, and I volunteer for TIE Access and TIE University. And I'm just trying to understand a little. I have a master's in finance. I've done M&A work and stuff before, but just trying to understand it from a startup perspective, and then from a funding perspective, so that I can help these founders out a little bit better than I am today.
Cool, great. So just curious, in your master's in finance, was there a valuation course? Because a lot of schools don't seem to teach valuation in finance.
I think there was components of valuation taught within corporate finance, but there was not a specific valuation course. So most of my valuation work or learning was really on the job.
Yeah, that's pretty typical, but I think more schools are adding it, and I try to volunteer to teach when I can.
Awesome.
Ash, Ash Thacker. Can you say hello?
I think I would pass on him. He doesn't have his voice ability on.
Active, okay. Kevin? Merck? No, he's on mute. Anyway. No, anybody else? Nada, can you say hello?
Yes, hello. My name is Nida Barkawi. I'm part of the Thai Atlanta Angels and Thai charter member and work a lot with Paul on access.
Okay, I don't think I asked Kevin to, I had to ask him to unmute. Kevin, are you able to unmute? No. All right, well, Raul, are you there?
Hey, Greg. Hey, everyone. Hope everyone's doing well. I'm Rahul Bakane, launching a media company, the Ticker Channel, basically an ad portal, but it's a content information and news aggregator for the users, specifically with the work verticals focusing on your trade journals and peer review journals. Always love your content, Greg, so there was no way I was going to miss this today.
Oh, you're too kind. Hope to see you. Gonna be there tomorrow or Thursday, whatever, TyCon?
Thursday,
I can't
baby.
be there Thursday. Sorry.
Oh, no. No,
But we'll try to catch up.
no bourbon tasting this year. Damn it.
We'll try to catch up though before you leave town.
All right. I'm here till the end of the month. Cecilia.
Hello, I'm Cecilia McManus, and I'm the Director of Customer Success with MedTransGo. MedTransGo won Thai Access last year, and we're an ATDC company, so I'm just eager to learn more. So have gotten a lot out of this course so far, so looking forward to learning more.
Sorry, what's your role there, Cecilia?
I am Director of Customer Success.
All right, I did evaluation for MedTransGo. Dana, right? Isn't she your?
Yes, she's our CEO.
Yeah. Well, I have to circle back with her at some point. I think I did one of your early option pricing valuation. And Ratan, is that how you say that?
Yes. Hey, Greg. My name is Ratan Bhavnani, and I've had about 4 decades in corporate, and now I am a mentor and strategic consultant on my own, and I'm very anxious to learn about what it is that startups do in the way of their evaluations, and so I'm here to learn so that I can help others and use the rest of my experience that I've had and bring that into the startup world.
Okay, great. Swami.
Hey everyone, my name is Swami Ganugapati. I work as a financial analyst in Honeywell, and I came through this M&A knowledge sharing session. So I thought it would be helpful for me to just get a bit of knowledge on the M&A side. So just joining
Sorry,
this session.
where are you located?
I work for Honeywell in Atlanta, so it's in downtown Atlanta.
Okay. Nidhi. Hello, Nidhi Awasha. Available? No. No answer. Okay. Eric.
Hello, is I'm audible?
Oh, there's Nidhi.
Yeah, I'm audible. Yeah, sorry, I think I lost the network. So hi everyone, hi Greg. So I am Nidhi Baushe, working with Delaplex, which is again an Atlanta-based or company. But I sit at Nagpur, India office, which is an India head office, and I work there as a manager, COE, as well as chain division in even on the India side as well. And I'm a Thai charter member at Thai.
Okay. Thanks. And Eric. Eric around? Not
He
able
said
to-
he can't talk right now.
Okay. All right. Well, let's get into it. Oop. Okay. So generally, let's take a look at the macro situation right now. It's not good. I'm sure we're all feeling it in our businesses and personal finances, one way or another. I have not, since I started my firm in 2011, seen such a slowdown in my business. This summer has, I've been very steady and growing almost lockstep very consistently for 10 years. And I had a great first half. Last year was another record year. I've grown about 10% a year. All of a sudden, about in June, everything just kind of dried up valuation wise. And that's a reflection of a lot of the headwinds that are listed here. Obviously, the high inflation, higher interest rates, supply chain issues have alleviated a little bit, or a lot over the past year or two, but still may affect some businesses more than others. Labor shortages, hard to hire good people. Energy prices, gas prices are still high. Affects some businesses more than others. Not so much the tech and software business, but anything transportation wise, it affects quite a bit. There's policy risks. Sometimes our current administration doesn't seem to do things that are business friendly. Some industries more than other, think oil and so on. Valuations are very low, and so it's not favorable to raise money when you have to give too much of your company away. And a lot of VCs are just holding off. They've been spooked by high valuations in the past, recent past, and they're just, despite having the one pro of having a lot of dry powder or capital available, there's just not a lot of attractive deals. Companies aren't growing. On the other hand, valuations may be low, but so it might be a good time to buy low and invest low for the right deals. But the only sectors that, sector in particular that seems to be hot is AI. If you have anything, .ai in your company name, it's almost like, feels like the first .com boom 20 years ago, and maybe that's not healthy either. So, but that's where the lion's share of the money seems to have gone so far this year, both in the public and private markets. So yeah, it's a difficult time. If there's not any funding activity, then there aren't new stock options being issued. People aren't being hired with the money being raised, which leads to stock options being issued to them, which leads to valuations, the IRS 409A valuations that I do. So there's definitely a trickle down effect to all of this. One of my favorite topics, and I don't really have a good answer for it, but I like definitively, I think it would be a good idea for everybody at some point, especially in school, to study whether or not trickle down economics work, or works. I think ultimately that's maybe the most important question in deciding what you believe about economic policy. Ultimately, the Democrats are pushing, they don't believe that. The Republicans do. I'm not going to make this political. I'm not really a political animal. I hate politics. I hate all the people that have we've got bad choices out there right now. But obviously, whatever is happening right now is not working. So a lot of these things were not the case in the previous administration, and money was flowing, deals were flowing. At least, you can claim it goes to the 1% and so all that, but obviously there is a trickle down effect. So in all the what at least the few ways I've mentioned it, it affects me. So I'm grumpy when I'm not, making money and busy. So yeah, I'd like to see things turn around and get some money flowing into the tech sector again for all of our sakes. So here's kind of where we're at year to date. Oddly, I think it's hidden behind this this window here. I don't know if I can shut that. There, we put it on the bottom. Just close it somehow. Oh shoot! How do we do this? The Nasdaq is actually up 33% this year, and the S&P is up 16%. But again, that's heavily skewed by AI performance and certain other subsectors. So not a little bit misleading. I could close this window. What other? This is a little outdated, just from May, but it's very indicative of what we've seen from a multiple standpoint in software companies, in particular from last fall. I'm sorry, from October 21 to May 22. So this is over a year old at this point. I haven't been able to get an updated chart on it, but I don't think things are substantially different. Maybe a little bit better, but from the peak, in some sectors more than others, you look at the high flyer here, which was fintech, and that's heavily Atlanta focused. We got a lot of fintech companies here. The most extreme example of fintech companies in public companies, were seeing about 25x revenue multiples, which was really crazy. And between 1021 and 522, all of a sudden they were looking at about a 4x revenue multiple. So that sector took about an 80% hit in its multiple contraction. Others, enterprise software, B2B, in other words, was over 15x. For a while, everybody was talking about 10x, being sort of the standard for B2B revenue multiples, but that's always been kind of a myth. That's another little story. We have time, so I'll share. But we've seen that went from a high of about 15x down to 7 or 8x. But in particular, it's worth pointing out that guidelines and sort of rules of thumb and are very dangerous and misleading. So with that being a good example, for a while, any company that was in B2B SaaS software would come to me and say that they thought that a 10x revenue multiple was appropriate. And I just kept asking why and where do you see that? And well, it's I hear, or they say, and well, like who? So I wanted some data, and so I used my financial databases like Capital IQ or Tagnify, and I use ticker symbols to pull real-time financial data from public companies. And the really important correlation that a lot of people miss is that between size and multiple. So the larger the company, especially the largest public companies in this B2B SaaS software sector, the higher the multiples. And it was, if I took a basket of about 50 of them, and listed them by size of revenue or enterprise value, either way, it wasn't until companies got to be about 2 billion before you started seeing a 10x revenue multiple. So the band between like a large band, 100 million and 2 billion, the median multiple was more like 4x, believe it or not. It was really surprising because there's still some large companies in there, but below 100 million, it really dropped off further. It was a noticeable drop where it was like 1 and 2x. So very surprising. And that's 100 million. So if you're, earlier stage companies with $1 million or a few million, $500,000 revenue, let's just say $1 million, coming to me and say, well, I'm worth $10 million. It really wasn't justifiable, and it was causing them issues in the funding markets and other things, option pricing expectations and so on. So we'll get into a little bit more about that lately when we talk about how to value early stage companies that might not be profitable or might not even have any or at least minimal revenue. But little sidetrack there, but an important point and bigger picture back to the point of the slide is that tech revenue multiples were basically hovering all below 10x, between 4 and 7-ish last year, and probably seen a little bit of improvement, but there's still more ways to slice the onion when we think about tech valuations based on size. So aside from sector, which we looked at there, here's a chart about deal volume itself. So deal volume in 2023 is also at the lowest point it's been since before COVID, back to Q2 2020. A little bit discouraging as well. It's picked up some in the second. Well, actually not. This is the volume line here. This is the valuation line. So this is another indication that valuations have ticked up some in Q2, but the deal volume itself is down 6%. What is that from when to when deal volume? Maybe that's 19 to 20. Well, I'm not sure what that's 6%. That's Q over, okay, quarter over quarter, just 1Q to 2Q, but the valuations are up. So this is a really interesting chart provided by CB Insights. CB stands for Crunchbase. It's a good premium tech market information service. They send out a helpful daily newsletter and issue useful reports from time to time. So stage by stage, it's interesting to see that the later stage companies have taken the biggest hit in valuations quarter over quarter and year over year. So it's interesting to think about why, perhaps, and the seed and angel stages are actually hanging in there better than any. So for some of us in the earlier stages, a little bit encouraging, but off of smaller numbers, lower valuations, that's, the needle's not moving a lot there. One of my favorite things to think about, and again, something I don't really have a good answer for, but I like to ask people the question, especially people in the game, VCs that invest in later stage Series D plus companies, as it says, is, in my mind, if a company gets to a Series D and they're still not making money, which means you're not raising money. If you're making money, you're because you're living off your cash flow, So to me, D stands for like danger or dog. So a really interesting question is to a VC, like, at what point do you bail out? Like, do you go to series F, G, J, K, S, Z? I mean, at some point, you either have to fish or cut bait. And it's a very tough decision, because either you want to continue to give the company a chance and prop it up while it's has a chance, or if you just think that this business model is never going to work, you just have to cut your loss. So I think in this economic environment, it makes it tougher for VCs to continue to justify pouring money into some of these long shot companies, or moonshots, whatever they call them. Some of these big VCs have these moonshot funds like Sequoia and Andreessen, and we've probably all seen the articles about how much they've struggled, and the value, you know, they just invested in some ridiculous things. One of my favorite little stories from when I was at SVB, and we valued all sorts of crazy companies, was one that some clean energy company that was literally flying air balloons through the jet stream somehow. And it was, it never seemed, after following it and valuing it for a couple of years, it just obviously wasn't going anywhere. At some point, they were literally trying to launch the balloons by like driving them off the back of fire trucks or something. It was all of our favorite one. We talked about it in quarterly meetings, trying to get an update on this particular company. So there are some others out there that might seem less crazy in their product. A couple prominent ones that some of us might remember, stories locally. Think of it in a second. It was the fintech Cabbage. Cabbage was a good one. It got a lot of attention for being a unicorn. You know, the CEO, who's would go nameless if I could remember his name, was a big speaker. You know, Venture Atlanta, all these. You know, it's a real icon for a while. Little did everybody know that the company was hemorrhaging money like hand over fist. I don't think we're talking out of school at this point, since it was acquired by American Express at some point, that they were losing about at least $30 million a year. This micro funding, kind of micro lending thing. But they raised their last round at a $1.2 billion. Everybody was excited, except me, saying, you know, why did you have to raise another 400 million if you, at Series E or F? And I said, this just isn't going to end well. And sure enough, within a year, I knew they were in trouble when I saw him speak and at some conference, saying he'd already started another company. It seemed like a plan B to him. He was like ready to jump out before the plane crashed. And Amex ended up buying that company within a year, that round, for like 800 million. So still a decent price, saved some face, but the last money in lost, you know, 33% very quickly. I don't want to mention the other one, but they might still be around. Anyway, I will. What the heck? Sales Loft, I think, is another one that has a lot of local people involved, and I think it had a similar profit profile, with being a unicorn losing lots and lots of money. I'm not 100% sure. I think they were acquired in the last year or so as well. But in any case, be careful about, you know, the hype in the media and such things, because unless you see the financials, you know, it's crazy how they justify some of these valuations. But there's a little bit of fear of missing out too, the FOMO. I think some of the investors want to, they have to deploy their capital. This is a good point. Professional investors, VCs, PE firms, etc., they have all this money. They can't just sit on it. They've got to put it to use. And at some point, when the markets were high, they were willing to jump in at ridiculous valuations, and they were even squeezing out smaller, medium-sized VCs that wanted to participate and couldn't deploy their capital. So that's a sort of a sign of the apocalypse when that kind of thing starts happening. And so and it comes back on them, you know, when the tides go out. So some lessons learned, and in my opinion, historically, we all know that phrase, you know, if you don't learn lessons from history, we're doomed to repeat them. It seems like lessons from the previous generation, they call generations about 20-year periods of time. We're about 20 years out from the first .com boom and bust, and here we are, another generation of business people, investors, founders, etc., didn't experience all that, and they just seem to have repeated the pattern over the past few years, thinking somehow this time was different. But here we are. So another useful point to make about tech valuations is not just based on size and stage, but also sector. B2B companies always get higher valuations than consumer tech or B2C, business to consumer. And obviously that's because software and such things have recurring sales. Selling consumer items one at a time is a long slog, and individuals aren't spending as much money as companies on whatever their services are. So in my personal business, obviously, I'm feeling that as well, because as a fun little example, my valuation business is B2B, even though it's a professional service. It's not a software, but it's still, you know, the prices I charge, whatever they are for valuation services, are far greater than my little passion project. And I'll tell you all more about that later. But I wrote a book on the history of pro football. It's called Gridiron Legacy, Pro Football's Missing Origin Story. And I spent 15 years researching, writing, laying it out. It's a beautiful coffee table book with a great story in there about how pro football was born in America and why the story has been lost. And it's on Amazon now as of August 15th. I'm doing a national radio media blitz podcasts. I've done about 25 of them over the past couple of weeks, coast to coast, New York, San Francisco, Orlando, Chicago, everywhere. But I'll tell you, selling books $50 at a time is not moving the needle, you know, for the bank account and the budget. So I love doing it. You know, whoever is in a B2C business, I'm sure they're very passionate about what they do, believe in it, but it's a grind. So that's a big deal when it comes to considering assessing any valuation as well. Let me take a pause. We've covered a good bit of ground. Does anybody have any questions on any of what we've covered so far? Okay. I don't hear anybody. At least I got a drink. So one thing that is a common question when I do these presentations and classes is what are the differences in terms between securities commonly offered in fundraising. We got the safe note, which we all hear a lot about, convertible note, and preferred equity. So working, I guess, backward, on the preferred side is the most common. I used to see data that said maybe 2/3 of fundings were priced rounds preferred equity. I think that's probably condensed more evenly with convertible notes for earlier stage companies. But the old line is that investors prefer preferred, and because they like the security of knowing exactly what their deal terms are, and they know that they are getting a liquidation preference, they're getting paid out first. Typically, the typical terms of a price round are a liquidation preference, a right, possibly it's an option. You can have participating or non-participating preferred stock, and participation means that you sort of get to double dip when the preferred equity converts to common stock. So there's extra value to that. And obviously each subsequent round, series A, B, C, D, has preference over the earlier rounds. So the earlier rounds get diluted when more money is raised. Convertible notes they are debt instruments. They typically have an interest rate of between 6 and 8%. They have a maturity date, typically a year, could be a couple years, and they have a cap. So it's very important to understand that a cap is not an actual valuation. It's just a ceiling. And so a typical cap for a early stage company might be, $5 to $10 million on an eventual priced round. So the implications of that are that there's a benefit, sort of a teaser for an investor to say, okay, well, I know it's not going to be more than whatever the cap is, 5 million, but if eventually the price round comes in at 10 million, then they've got a guaranteed 2x return baked in there. So caps are good things for investors, and so are discounts. So typical to have a 10 or 20% discount on a convertible note. That means that if the price round comes in at 10 million a few years down the road, and they have a 20% discount, they're actually going to get it at 8%. I mean, 8 million, assuming there's no cap on that, or at least a cap at 10 million or up. So all those things are favorable for the investors and make it more appealing to potentially invest in a note than a priced round. Safe notes became more common, I don't know, 10 years or so ago. Stand for simple agreement for future equity. And most people, at least in the Southeast, seem to think that they're too simple. They're not very popular in the Southeast, and particularly Georgia, Atlanta. Organizations I participate in, such as Atlanta Technology Angels, Thai Angels, most investors just won't consider investing in a safe note because it's not a debt instrument. Even there's no interest rate. You're just sort of, and there's no maturity date. There's no particular rush or time frame that it's going to close out. It may or may not even have a valuation cap or a discount. So just kind of handed the money over and hoping. So it's more popular out in the West Coast. Y Combinator uses these things very typically. They have standard safe note agreements. It's just not very appealing from an investor standpoint, and I typically try to discourage anybody that comes to me, founders asking or telling me that they're thinking about raising money on a safe note. It's going to be tough around here. So good time to talk about valuation methods. How are we doing on time so far? I think we're about 45 minutes in. Again, we're going to work backwards from right to left here in terms of the methods that we use for valuation. And they're selected based on stage or maturity. So an income approach is the most preferable valuation method to use always when possible. But to use an income approach, also known as a discounted cash flow method, or DCF, we need positive cash flow. And it's really not even sufficient to say, well, we just broke even for the first time, so it's not really a trend of profitability. We're looking for more of a history, at least a couple of years of proven profitability to feel comfortable that the forecast on which we're going to base our discounted cash flow calculations are reasonable. So, but it's always preferable to a market approach, and whether revenue multiples, EBITDA multiples, public companies, private companies, because it's specific to your company, the company that we're valuing. There's always dissimilarities of some degree to other companies, and those are very hard to tease out, and you might not even have enough of them, or the multiples might be all over the place. Very, very difficult to assess what an appropriate multiple on revenue especially should be, without the ability to have positive EBITDA or cash flow to base your valuation on. But if we have to do a valuation in those situations, then that's all we have left to use. But so we like to have it's easier. I mean, and this is why my expertise in valuing so many hundreds of early stage companies is important, as opposed to giving myself a little pitch here, ding ding, or pat on the back, but to go to a firm that hasn't done as many and isn't comfortable, doesn't have their finger on the pulse of such things, makes them uncomfortable or less accurate. Many firms don't want to do early stage valuations for two main reasons. A, they typically don't charge, they can't charge as much. Early stage companies don't and aren't willing to pay big firm fees for valuations. And B, they don't know how to do them. So maybe it's an excuse to say, oh, well, if we're going to have to do this, we'll charge you $10,000 or $15,000. Maybe they just don't want to do it because they're not good at it. So very down the middle for any of the larger firms, they want bigger fee engagements. They want predictable methodologies. They can do the DCFs all day long, and it's just a question of a couple variables that they have to sort out. In particular, the forecasts and the discount rates, and maybe some what they call normalizing adjustments, to sort of quality of earnings kinds of things. So I do all of the above, but more than any other firm around, Georgia, maybe even the Southeast, I do more earlier stage companies. So when you do an income approach, though, it's good to also corroborate or triangulate your answer with results of other methods. And that's why I have the plus here, plus the market approach. And you can do two methods within the market approach. One is the public comparable company method I mentioned, and the other is the private company M&A transactions. So public company data is available manually through 8 forms, 10Ks, and so on, quarterly 10Ks, 10Qs. And back in the day, before subscription data feeds were available, it was painful for valuation people, and it took a long time, and therefore a lot of money that they charged to go through and manually input, search by SIC codes and NAICS codes, pull these reports, manually input the data, maybe make typos. It was very painstaking. But now at the touch of a button, although it's not cheap, but it's worth every penny to be able to just input a ticker symbol into your model with this data subscription and have it populate your model. So, and you're guaranteed at least offloading the risk of inaccuracy to them. So the one I use is called Tagnify. I'll give them a little plug. They're very good. They're based in Florida, and they're much more cost effective for valuation firms than the mega databases like PitchBook or Capital IQ that charge $20,000 and up a year, but you get the whole ocean of data from things 95% of which you don't need on fixed income and all kinds of derivatives, who knows, the world markets. And I just kept telling them before there was another option, I don't want all that. Can I just get this little app that you have, I forget what they called it. It was a little separate piece of software, just to give me the public company, comparable public company information. And they said, no, you can't. I'm like, someday somebody's going to eat your lunch, and I'll be the first to jump off the ship, because it was just irritating for small firms to have to pay that much money. And sure enough, a couple of them have, and I'm able to save about 80% on those fees, which helps my bottom line quite a bit. So anyway, there's also private company transaction, M&A transaction databases. So we can buy keywords or various industry codes, also pull lists of transaction prices and multiples. Not always that available. A lot of them aren't reported. Maybe they're reported, but not with the financial information. But usually there's enough out there to be helpful, at least to use them as not primary methods in the analyses, but at least confirming methods to say, okay, from my income approach, I conclude on X and that. So what does that conclusion translate to in terms of a multiple based on the company's financial? What is the implied revenue multiple and implied EBITDA multiple from the equity value that I've concluded on from my income approach? And if I can sort of interpolate that number and say, okay, well, it's 6x EBITDA and 3x revenue, then I feel pretty good about that based on the range of multiples from the comps, both private and public. But if any one of them is out of out of line just doesn't make sense. It's a good thing to say why. So one of them's wrong if you're not within 10 or 15%. And so then it helps me challenge my assumptions and my inputs and variables and say, well, maybe my discount rate is off. Is there more, if my income approach is coming in too high, maybe the forecasts are too high. Maybe I'm not discounting them enough because there's more risk there because the valuations of these comps are just lower, and this private company shouldn't be that high. That's sort of the purpose of presenting multiple methods. But without, again, the income approach, if you can only use the two market methods, you might not feel as good about your conclusion, or you have to give a lot more thought and research to make sure that you're comfortable with the comps that you've selected, and sort of be comfortable knowing, maybe from previous experience, also other valuations that you've done, what a range of reasonable is for a certain size company in a certain sector. And we're going to get to that when we do an example in a bit. So then going to the very earliest companies, so the market approaches without positive cash flow are probably only create meaningful results when you have companies about $500,000 in revenue and up. Otherwise, obviously, applying any multiple to zero revenue or zero, negative cash flow is not meaningful. NA, useless. So we need another way to look at pre-revenue companies and companies that just have minimal revenue. And that is a thing that I use. I didn't create this method, but I've sort of made it my own. It's called the scorecard method. We're going to talk about that. I get the question all the time, how do you value a pre-revenue company? So there's a guy named Bill Payne who wrote a white paper years ago on this method. And the gist of it is that he creates a weighted methodology, about 6 categories with, I thought I had another maybe slide in there. The strength of well, here we go. The management team gets about 30% of the weighting in their experience. It's always good to have an exit or two under the belt. That's very attractive to investors. So we do an interview. We spend about 90 minutes typically on a call interviewing the CEO and or CFO, whatever, and we go through about 25 questions in each one of these categories. The size of the opportunity, the market size, specifics of the product itself, including any IP that's out there, competition, marketing, sales partners, channels that have been established, distribution partners, funding situation, financial health, and then sort of a miscellaneous. So it's this interview results in a score or factor of greater or less than 1. One's is par. And then that factor is applied to a value that's derived from data on fundings that I track for over 10 years and update yearly, quarterly, whatever. The data's become more available, and over the years it's become better and it's become available more quickly. Used to be a long lag time, just only annual data would be published, and then it wasn't helpful if you're in the second half of the year because you're relying on stale data at that point. But we have to look though at several things to come up with a baseline value to apply that factor or score to. And if you think about it, you know, a number, if we read an article in the Wall Street Journal or PitchBook or somewhere, some Bloomberg, some publication, and says, well, you know, the median angel stage valuation in 2022 nationally was $5 million. Well, so then somebody, you know, that might encourage a company going to pitch to ATA, regardless of what they do or what sector they're in, you know, to ask for a $5 million valuation. Like, well, that's not helpful and very bad, you know, misleading in several ways, because it doesn't consider so many things that need to be considered. Angel, first of all, the stage, angel itself could mean anything from pre-revenue to maybe $500,000, or before, you know. And these data sources, from one to another, they never give you their criteria for where they draw the line between angel and seed stage. So it could be $500,000 or $1 million. And one of my favorite stories was a venture capital VC from New York came to ATDC a few years back, some networking event, and I was speaking with her about, you know, trying to be helpful. How can I help you? Can I show you some deals? What do you like to invest in? What sectors, you know, size, stage, whatever. And she says, well, you know, we're New York seed. We're not Atlanta seed. I'm like, what does that mean? Well, New York seed is $1 million in revenue, and Atlanta seed's $500,000. I'm like, oh, okay. Thank you for the information. So you don't even know when you're looking at a PitchBook or Capital IQ or whatever data source you might be looking at, what are they calling angel and seed? I mean, and then the term pre-seed came into being, you know, a couple of years ago. So where's that line? And one report to the next might totally throw you off if you're trying to compile such data to base evaluation on. So that's just one thing, the stage. Another is the region. Just saying, and taking a national valuation number is not helpful at all, because those numbers are substantially biased by the tech hubs, the Valley, Austin, Texas, New York, whatever. And Atlanta has always lagged the median national value. So, and that number seems to be condensing a little bit over the past few years, but in the past, it wouldn't be uncommon for Atlanta to be at least 30% less in its valuations for any stage company than the median. And for a while, maybe it's 20, maybe it's 10. More recently, the data you see from different sources, again, varies, but it's still very important if you're advising somebody pitching here to consider, you know your audience, get some insight ahead of time. What have these people in this group done in the past? What's their sweet spot? Because it's probably not the same as what you'll see if you're pitching in the Valley. Super important. Again, size, you know, you have to split hairs between, if you're doing an angel valuation, between pre-revenue, $250,000, $500,000, just like with super large companies, valuations tick up, right, as you go along. If everything else the same, if one's got pre-revenue and one's got $500,000 in revenue, that they can ask for very different numbers if they're raising money. I mean, you've got traction that's huge in your valuation, even though they're both angel stage deals. So We've talked about sector before, B2B, B2C, B2B2C is a thing. And not just that, but is it healthcare tech, fintech? Those have been on the hotter side, but things like education tech, ed tech, or ag tech, agricultural tech, struggle, historically. Government tech went with longer sales cycles, hard to justify similar valuations to other sectors. And again, we talked about year to date. We have a very cool tool that allows us to take a basket of public companies, and just based on their ticker symbols, and compare their market prices between any 2 dates. So we can put in the end of 12/31/22 and then yesterday 9/11/23 and say, in these 10 stocks in your sector, what's gone on this year? And maybe that they're down for the year while the market is up on the whole. So it informs a founder, anybody raising money, issuing stock options, that you don't just necessarily track the broader market. Some sectors are really still lagging others. And then all those things go into the blender to come up, as we said earlier, maybe that national angel valuation was 5 million, but when you make all those 5 adjustments prior to the company specific adjustment, you're coming up with an entirely different analysis. So we're over an hour here, and I still have my voice. Any questions at this point? We're going to do an example now. Okay. Oops. We got a CEO pitching an angel stage company in the Southeast that's pre-revenue, B2B SaaS healthcare, first-time CEO. And at this point, when I did this was in February of 23. And at that point, we had a median fourth quarter 22 national angel stage valuation of just about 5 million, 4.9. But then when we make those adjustments we talked about, and apply a 20% hit on the Southeast region, a 10% hit for being pre-revenue on the zero on the low end of angel, a 30% premium for being in a hot sector, the B2B sector, based on research, and a year-to-date bump of 10%. At that point in time, the market was up 10%, at least in that sector for the comps that we looked at, as I described. And then, since we've got a first-time founder, first-time CEO, and other things, they come in on the company-specific score at 0.8, a little less than par. So all that nets out to a negative minus 10%, which hits the valuation from 4.9 down to 4.4. So that's going to help keep that founder in the game and not spook potential investors here locally if they're pitching at ATA or TI, whatever. Give them a better shot to raise their money, which is super important. So that's just to come up with a value of 100% of a company. And however, if you're doing an option pricing valuation, the option price is not just simply a division, the equity value divided by the number of shares. In this case, we had a company that had 3.6 million in a value and about 1.2 million shares. If that was a straight math problem, you'd come up with about $3 a share. But in option pricing world, you also get discounts for lack of control, aka a minority shareholder interest. You don't have the voting rights and so on, or voting control. And you also get a huge discount for being an early stage illiquid company. So that discount will vary depending on the stage, but you can get upwards of 50% or more discount on the option price to provide the employees with a suitable incentive for the long holding period that they will endure while working for the companies. So that is the extent of the analysis. I have lots of stories and I can answer lots of questions depending on how much time you'd like to spend. But again, I will open it up to the floor. Yeah, Raul, Cecilia, Paul's even joined us. Uthan.
Hey, Greg,
Anybody?
I've got a question for you. This is Deb Pock. So the last team that I mentored, they had a safe. And can you just explain to me in a little bit more detail or give me an example of why that is such a bad thing? I mean, I understand it's open-ended. I guess I really don't understand. Yeah, I don't understand why it's such a bad thing.
So
what would I have told that that founding partner? So she went in to Thai Access and she could have, they have a really great business model. They don't have a whole lot of revenue traction yet, but they had a great, really great product, but I'm not sure how much of the safe had to play in it. So I'm just curious.
So if I'm a potential investor sitting there in the room and somebody says, okay, I'm just offering a safe note. Okay, well, what are the terms of the safe note? Well, you don't, there's no valuation cap. I mean, worst case, it could have a valuation and a safe note might not. They might have a cap or they might not. So they might just say, well, safe, it's an uncapped safe note is the worst of all worlds. So I don't have a cap on it. So the future valuation could be anything. And I have no benefit of a cap if it comes in over, any particular cap that would otherwise be there. I don't have a discount to the future valuation, so I'm not getting a benefit of 10 or 20% on whatever valuation ultimately happens. Maybe there's no term. I don't. It doesn't end in a year. It's just open-ended. I'm going to wait forever for a potential funding to happen or not, without getting my money back. It's not debt. It's not a note. It's just, I don't even know what to call it. There's just nothing really good about it from my standpoint as an investor. I mean, it's a total leap of faith. It just kind of giving the founder a blank check, to work with without any commitments, or obligations. It's great for the founder if you can get it, but does that make sense?
Yes, it does. Thank you.
Anybody else? I don't know how.
This week again. Can you talk through the cap ceiling a little bit?
Yeah. Sure.
And
So
just
what?
the impact on the investor.
Yeah.
I understand the discount convertible. Now I understand just the open-endedness of the safe, and I would like to just understand a little bit more about the cap impact.
So it does cause a lot of confusion because even sophisticated and experienced investors tend to just think of a cap as the valuation, as the founder's perception about what the valuation is. And caps don't really bother me. I mean, I've invested in, a handful of convertible notes with caps. And even if the cap is too high, which causes so many investors, anxiety, let's just say that company puts a $15 million cap on it. Well, let's just say, okay, I don't think they're going to get that, in a couple of years, but if they don't, so what? It doesn't, no harm, no foul. If it comes in at 7 or 8, it is what it is. And I still get hopefully the discount that they're offering, 10 or 20% off whatever they ultimately achieve. But I guess the real problem with it being too high is maybe there's not that extra potential benefit, where if they set it a little lower and they outkick their coverage and they achieve a higher valuation, then I get a better deal because I get the money, my valuation at the cap that they set minus any discount that's there. So, but it's not a huge deal. Obviously, if they set it ridiculously high, it just kind of says that they don't know what they're doing. And that can be discouraging, but I don't know. I've seen pretty good companies maybe not achieve, some funding because, maybe the investors thought the cap was just a little bit too high and said, oh, I don't like a $7 million cap. I think it should be 5. Well, that's not going to kill me if I really like the company. Does that make sense?
Yes, it does. Thank you.
Mm-hmm.
And another question, you mentioned that you had the ability to access private equity or private entity transactions. What source do you use for that?
Yeah, there's a handful. There's Capital IQ, Crunchbase, used to be called Pratt Stats, but I think Business Valuation Resources acquired them, BVR. Those are 3 that come to mind. I'm sure there's others out there.
That's cool. Thank you.
Gregg, are you seeing any big difference as you're doing valuations in this last 90 days or even 6 months versus a year ago? And what would you tell us as investors we might consider from what you're seeing as the differences?
Hi, Paul. I haven't seen you for a while. And I probably haven't seen you because I've been out of the game more, in my new Florida residence. So I haven't been attending, to your question, a lot of the meetings, seeing as many pitches in ATA and TIE as I have.
Or valuations you've been doing, or you've just not
Well,
been doing
those are the right valuations themselves. It's very sector specific still. There's just been so few fundings that the volume of fundings is, as I showed in one of the charts, is way down. So there's not as many data points. Overall, it feels, the valuations that I'm doing are down because the performance it's not an indicative of the fundings. The funding is largely dried up as well, but the valuation conclusions I'm reaching are lower because the companies are underperforming. they're not achieving their forecast. So year over year, we're seeing that their valuations decline, if that makes sense. It's more a function of performance than the market. Multiples aren't, that different. It can vary from sector to sector, but they're, I think mostly what I was seeing earlier this year was things were down about 10%, multiple wise, in the public comps in most sectors.
Okay. I was trying to help a friend out with an ed tech business, and it did seem like multiples were down in his industry anyway, but it may be a factor of a lot of things. So thanks.
Yeah, sure.
And Deb, just a little piece to give you, safe notes are usually more founder friendly. I, as an investor, don't like them because, like Gregg says, there's no cap. Typically, the pure safe note has no cap, no interest rate, and hence a convertible note at least becomes more of a potential win-win. And I'm wondering if your question about the debt, the cap ceiling, did we answer you? Did Gregg cover all the parts you were asking, or did you have a?
Yes, he did. I
additional
kind of
question?
thought through
Okay.
it a little bit more. So yeah,
Got it.
I'm good. Thank you.
Back to you, Gregg.
Okay. Well, back to the audience. Any other questions? I have a little interesting story to tell, an example, a real life example of a interesting project I did. If there's no other questions. So last year I spent several months really on a very interesting valuation in a partnership buyout situation. So there was a negotiation involved, and we had a minority ownership interest, say, let's just make up some numbers. So to protect the innocent, let's say one party owned 25%, the partner who was leaving, and the CEO founder owned 75%. So I think it's useful to talk about the sector, though. It was a digital marketing company, so very typically pretty hot sector, but there's a lot of them, a lot of competition, but there's a lot of demand for those services. A lot of times when I'm doing going through a scorecard exercise with a client, I'll take a pause and ask them, when we're talking about their staff, any roles they're looking to fill or any services that they need, accountants, lawyers, HR software, digital marketing. More than anything, they say, oh, I need a digital marketing firm to help me start getting some traction. And especially when the economy's better, companies are willing to spend on marketing. So this particular company, let's just make up a round number of had about 5 million in revenue. And the minority owner comes and says, I'm leaving, you need to buy me out according to our operating agreement, but there's no particular multiple, or, all the operating agreement says is, got to get an independent valuation. So, or more than one, they can, each get one, or so. The CEO started by asking the other, well, what do you want? Which you have a proposal, and the other one said, well, I hear, I've read that revenue multiples for digital marketing companies about 6x revenue. So 6 times 5, 30 million. I own 25%. So give me 7.5 million, and we'll call it a day. Not so much. So, as I said, revenue multiples, first of all, rules of thumb such that are not helpful. especially revenue multiples. Think about it. You could have two companies that have 5 million. One could have 50% margins. One could have 5% margins. Are they worth the same? Heck no. Right? The bottom line is what matters. It's how much cash you're making, not how much your top line number is. So just throw that, offer right out the window from square one. An EBITDA multiple would be much more helpful. And one thing I learned, the reason I wanted to mention it, digital marketing, is because from my experience, having valued several of them, is that their margins are all over the place. Because there's different sub niches of digital marketing. It could be search engine optimization, SEO. It could be ad tech, or it could be more software driven, or it could be more of a professional services, kind of like an agency. So you can't just do a keyword search. And first of all, there's very few, if any, public digital marketing companies. So it's an example where that's not helpful. And you're going to really rely you need to rely on the income approach. As we said, it's company specific. Look at the company's actual performance and its actual margins, not relative to any of these very disparate range of multiples from acquisitions that may be out there. And there's several of them. So there's a lot of data on those kinds of things. And I know a lot of people in that sector and other companies, and they were very helpful, pointing me to resources and so on. So that's what the analysis boiled down to. It had to be an income approach, and it was going to be very, entirely driven by this company's performance. And then we'll look at, as I said before, what, based on that answer, after all the necessary adjustments that had to be made, and there were several for things such as owner compensation, that it's very typical in a privately held business that a CEO might overpay or underpay himself or herself, depending on their interests. So normalizing a compensation based on a database out there for executive compensation is very important. In this case, CEO was underpaid. So we had to adjust what the earnings would be with normal, compensation. And there's other, if things like club memberships or family on the payroll, kids, spouses, boyfriends, girlfriend, whatever. I've seen it all. You have to, again, we call it normalize the expenses. Normally they're add backs. So the EBITDA, cash flow is going to be higher when you add these things back, making a company more valuable than the way that a CEO would manage, maybe to reduce taxes or whatever. So after all these things, this particular company, there's also a management style. I mean, this particular company hoarded cash. Maybe they had excess cash. So, some of that cash had to be attributed, just paid out, just pro rata to the person leaving. So all these things had to be negotiated, but and explained. First of all, the first step was sort of educating them both on the methods, because they're marketing people. They weren't very smart people, pretty successful company, but didn't understand valuation, which is not typical, not uncommon, and needed some basic education. Like, this is how we're going to do this. This is why revenue multiples are not an option. We're going to do an income approach. These are the variables, the forecast. We need you to collaborate on agreeing on a forecast, because you're going to have different opinions about coming out of this, what was then a recession, about what the company's future looks like, and you had a really bad year, so which was atypical. So after explaining things and saying, okay, this is what I need from both of you, ultimately they were still far apart, a couple $1 million apart. It was clear it wasn't going to be a $30 million company. It was going to be far less than that. But once they saw what the inputs were and how the methods worked, I said, okay, owner, give me your set of forecasts and about 6 or 7 things, based inputs, variables, your opinion on these. Other side, do that. Let's see how far apart you are. We're still between the CEO was coming at like less than $1 million on her value, and the other one was coming in at a couple million. So very, I guess, with that being the 25% share. So in the end, after all I looked at both of theirs, and they agreed to let me mediate and arbitrate for them because they both liked me and trusted my approach. The minority shareholder had an advisor, a good one, very good one, had great questions and very valid points, and some things that I incorporated from Tech CXO, very good firm, and was very helpful in refining the analysis and validating, acknowledging, the methods and the approach that we were using, and giving that confidence to the person leaving, because the value was coming in so much less than the original take from the revenue multiple suggestion. So with that, so we had a good group working on it together positively in a collaborative method. The two parties weren't happy with each other. They got, of course, there's some frustrations along the way, but in the end, we got to a very sane, confident number, and I think maybe the company ended up worth, being more of a professional services type model. Generally, there's a rule of thumb out there that accounting firms, consulting firms, professional service firms are typically worth about 1x revenue. For what revenue multiples are worth, that's just something that exists out there. And it happened to turn out that on a 5 million revenue company, the company was maybe worth 6 million or so, and the partner walked away with a quarter of that. So far, 6 million being far less than the 30 million initially requested. It's a very good real life example of the process we went through, and the dangers of using revenue multiples, and how an income approach with all the necessary thoughtful adjustments baked in can lead to a good answer. And that was highly vetted by several parties on both sides, wanting to be confident that it's a lot of money for a small business owner to have to stroke a check even for over $1 million. And of course, another option and variable in negotiating such a thing is the payout. It can be paid out over time. So there was a 3 or 4 year payout structure, and you bake an interest rate into that as well, a risk-free rate or whatever. But super interesting case study and an example, useful to talk about. So any questions on that? All right, well, I don't know if you all if there's CPE or whatever, if we're going to hold our feet to the fire to get to 2 hours, but I'm pretty talked out. My voice is getting raspy.
There's no hard number like that, Greg. Whatever you and the group need.
Mm-hmm. Anything else I can help with?
Greg. This is Nita. This was very useful. Sebastian, do we get a recording of this?
If he's pulled away, oh, go ahead.
That's correct.
Okay.
Everything
All
will
right.
be on our YouTube, and then I'll send a follow-up email as well.
Okay. Thank you very much. That was
No
very
problem.
useful.
Sure. Glad you enjoyed it. Thanks, everybody, for attending. If you see me
Thank
at
you, Greg.
next, be sure to say hello.
Oh, are you coming into Commerce Tech Connect?
I am
this
back
week?
in Atlanta. I came in
Oh.
just for the occasion. I wouldn't miss it.
Awesome.
Last year was so much fun.
See you there.
All right.
Bye, guys.